Britain built the best financial machine the world had seen. It also ran the largest empire the world had seen. People assume those two facts are the same fact. They are not. The machine made money, the empire did not. Counting defense, administration, and garrisons, the empire ran at a loss. The economic historians who added it up agree on this. British taxpayers subsidized it. A narrow group in London profited. Bankers, insurers, bondholders, and shipowners, not the factory towns. So the real question is not whether the empire paid. The question is who paid and who collected, the ledger. In 1694, England was losing an expensive war against France. The crown's credit was poor, and everyone knew exactly why. In 1672, Charles II had stopped paying his goldsmith bankers over £1 million, called a pause, in practice a default. A ruler who suspends payment once pays more forever afterwards. The Scot William Paterson had proposed a structural fix years earlier. Chancellor Charles Montague was the man who actually made it law. A private company lent the government $1.2 million, 8% interest, and a charter to issue its own notes. The loan stayed on the books until 1994, 3 centuries. Most rulers borrowed short, spent it, and defaulted on schedule. Britain borrowed long instead and never repaid the principal. Parliament attached specific taxes to specific loans. By statute, lenders could see which revenue stream was meant to pay them. The old story says this instantly made British debt cheap. Recent work shows the cost of borrowing fell only slowly. Risk premiums stayed high for decades after the Glorious Revolution. By 1751, the debts were merged into one consolidated stock. Its rate settled at 3% with no repayment date. Britain still borrowed far cheaper than France, and that decided wars. In 1720, the South Sea Company offered to absorb national debt. Holders would swap government bonds for shares in the company. Its actual trading business was small and largely unprofitable. Shares rose from about £100 to £1,000. Politicians received shares on terms requiring no payment up front. The Bubble Act was passed in June before the collapse. It was lobbied for by the South Sea Company itself. Its purpose was killing rivals competing for the same money. The crash came in autumn and ruined thousands of investors. Historians now argue the act changed far less than claimed. The East India Company was a private firm with an army. It won at Plassey in 1757 and became a political power. Then, in 1765, it obtained the right to collect Bengal's taxes. A trading company now held the revenues of a province. Its London shareholders expected dividends out of that tax revenue, so it borrowed heavily against revenue not yet collected. A credit crisis struck London in 1772 and the company failed. It was too entangled with British banks to simply fall. Parliament lent it about £1.5 million and took supervisory powers over the company in return. In February 1797, war panic drained gold from the bank. Convertibility was suspended. Notes stopped being redeemable in gold. It was declared temporary. It lasted 24 full years. Britain fought Napoleon on paper that nobody could actually redeem. The pound lost value, but far less than people feared. Roughly 30% at its worst point, then recovering. A fierce argument broke out over what had caused it. Ricardo and the bullionists blamed excess issue of notes. Parliament rejected the report, then eventually did what it recommended. Full convertibility returned in 1821 at the old pre-war parity. Banking crises kept arriving roughly once every 10 years. In 1844, Robert Peel decided to legislate the problem away. The Bank Charter Act split the bank into 2 departments. Notes beyond £14 million require gold held in reserve. Note creation became mechanical. No judgment, no discretion, no exceptions. The theory said panics would then become mathematically impossible. In 1847, the Treasury wrote permission to break the limit. The permission alone calmed markets. The limit was never exceeded. In 1857, the limit was broken. In 1866, broken again. A rule suspended at every crisis is not really a rule. Auvergne Gurney was the largest discount house in the world. It made its money holding short-term commercial bills safely. Then it moved into railways, shipping, and long illiquid loans. It borrowed at call and lent for years. Everyone does this. In May 1866, it asked the Bank of England for help. The bank judged it insolvent and refused. It stopped payment. The following day became known in the city as Black Friday. Dozens of banks failed that week, 200 firms within months. Walter Bagehot then set out the rule central banks still follow. In a panic, lend freely, on good collateral, at penalty rates. The empire needed banking in places London could not supervise. Colonial banks were chartered under strict rules from the Treasury. They issued local notes, but only against sterling held elsewhere. Mauritius got the first true currency board arrangement in 1849. West Africa received the model in its cleanest form later. Reserves sat in London. Local money was a claim on sterling. There was no local discretion and no local monetary response. Defenders called this discipline. Critics called it engineered dependence. Both are describing the same mechanism from different positions. A colony in recession genuinely could not print its way out. India was not simply a market. It was a settlement mechanism. India ran trade surpluses with much of the world for decades. And it ran a permanent deficit with Britain by arrangement. Britain billed India for its own administration, called home charges. Pensions, army costs, railway guarantees, debt service, all charged there. India's surplus with others settled Britain's deficit with others. This triangular settlement is well established in economic history now. Council bills moved these transfers without shipping any metal. How large the transfer was remains genuinely disputed among historians. That it happened is not disputed by anyone serious. A merchant in Brazil buying goods from Japan used sterling. Neither party was British. The goods never touched Britain. They used a bill of exchange accepted by a London house. By 1912, London financed over 60% of world trade. The acceptance house guaranteed payment for a small commission fee. Its signature turned an unknown promise into a tradable asset. That signature was worth more than the cargo it covered. Britain ran a deficit in goods and a surplus in services. Shipping, insurance, and finance covered what manufacturing could not. The most profitable export was never a physical product. Barings was the most respected merchant bank in the world. By 1890, it held enormous unsold quantities of Argentine debt. Argentina stopped paying. The paper became impossible to sell. Barings had assets on paper and no cash at all. If Barings fell, every London acceptance became instantly suspect. William Litterdale of the bank organized a guarantee fund instead. Rival banks jointly guaranteed the liabilities of their own competitor. £17 million, because the alternative was losing everything. Gold was borrowed from the Bank of France to hold reserves. Barings was wound down quietly and rebuilt within a year. In 1914, Britain was the largest creditor nation on Earth. 4 years later, it was a substantial debtor to America. The national debt rose from under $1 billion to $7 billion. British investors' foreign assets were sold to pay for munitions. Around 15% of the foreign portfolio went that way. Britain borrowed from Washington to lend onward to its allies. Those allied loans were largely never repaid in any form. Gold convertibility was abandoned in practice as war began. The formal end came in 1919, once pretending became pointless. 80 years of financial supremacy were spent in 4. In 1925, Winston Churchill was Chancellor of the Exchequer. The bank urged returning to gold at the old pre-war parity, $4.86, the rate of 1,914. Prices had risen since. The old rate now overvalued sterling. Keynes put the overvaluation at roughly 10% and objected. Later estimates range wider, but everyone agrees it was overvalued. Overvalued currency means exports cost more than competitors' exports. Coal, steel, and textiles carried the cost of that decision. Wages had to fall for the exchange rate to work. Coal owners cut pay, and the general strike followed in 1926. By 1931, defending the pound had become simply unaffordable. Gold was leaving and interest rates could go no higher. On the 21st of September, Britain abandoned gold permanently. The pound fell, exports recovered, and cheap money did the rest. The thing everyone had feared turned out to help. Countries trading with Britain simply pegged to sterling instead. They held their reserves in London and settled trade in pounds. This informal bloc became a formal system in September 1939. Exchange controls pooled the whole area's dollars in London. Sterling kept its role by shrinking the territory it covered. During the Second War, Britain bought supplies across the empire. It did not pay in gold and had no dollars. It credited the supplier's account in London and carried on. These accumulated balances were held in blocked sterling accounts. By 1945, the total stood around £3.5 billion. India alone was owed roughly £1.3 billion. Egypt was owed several hundred million. Others held large balances. The colonies had involuntarily financed the war effort of the metropole. Convertibility was tried in July 1947 under American loan conditions. It was abandoned 5 weeks later after losing $1 billion. The pound was devalued in 1949 and again in 1967. The empire ended owing money to the places it ruled. None of this was ever designed as a single system. A bank chartered to fund one war became a global institution. A debt nobody repaid became the safest asset in existence. A rule against crises was suspended at every actual crisis. The machine worked. It simply did not work for everyone. And what accumulates without design unwinds without asking permission.